But hi everyone. My name is Alena Salonina. I've been an investor for a decade now, always kind of a later stage investor, not a true VC, which you guys are dealing with. But what makes me really care about earlier stage funders, pre-seed, seed, and specifically female, is because when I am looking at deals at Series B, C, E, and down the alphabet, I don't get enough female founders and CEOs or in these conversations, and it makes me very upset. Because when I chat with my friends at accelerators and incubators, they proudly say that it's like a 30% cohort is female founders, and then means I'm losing them in between. And one of the things how I'm trying to change it is to share what I know and be helpful. And I know that we need a very powerful energy when we walk into that room to fundraise, and how we talk about things. If we don't know a word that someone said, we kind of losing that energy and confidence. So I'm a finance person. I'm an investor. That's what I know. I know what we are looking for at this side of the table. So today we will chat, and I don't know if previous sessions covered it. So if I will be repeating something, maybe I will have a different perspective. It's always good to understand that we're all different investors thinking differently, and it's not that one person is wrong and another person is right. We're really just very different, and that's good for you guys to know and have that experience as well. Am I able to share my screen? Perfect. And just like a housekeeping question, are we doing questions as we go, or it will be all at the end?
It'll be
Because this session is
totally
very
up to you.
long.
Yeah, it's totally up to you since we have sufficient time. Maybe we should club all the questions towards the end. It also gives the overall perspective.
Okay. I will have kind of separate sections, so maybe let's do like by section so it's easier,
Okay.
and we're not trying to answer a question that was related to the beginning.
Fantastic.
So you see the slides, right? Okay, perfect. So yeah, one of companies that I run called the RAR Studio, and that's basically educational platform for female founders. So that's what you see here. This is kind of my brand that I'm using when I'm doing this educational sessions. So today we will start talking about just understanding overall what we call capital stack, meaning there's various types of investments that you will come across in your fundraising journey, and you need to understand how they all play together. And this is where we'll start. So capital stack, as I said, is a structure of different types of financing between equity and debt. And it's very important for you guys to understand how different type of investors tolerate risk and what type of returns they're looking for. So, for example, I'm a credit investor. My risk appetite and the way I'm structuring deals, it's very different from your true venture capital firm. And you need to understand why is it different. So this pyramid is listed from highest risk and highest return to lowest risk, low return. So common equity, it's basically common shares that give shareholders voting rights in a company decisions and any residual claims to profits after all obligations are met. What does it mean? You as a founder, most of the time you are owner of common shares. Any employees that you're granting options or giving them piece of the company, most of the time are common shares. So you are part of the decision-making process in your company, depends what piece of it you have. And potentially, if you go in IPO, you will probably get the highest return in a percentage-wise, not absolute basis. But you are last in line to get any proceeds. And if you come across any cases when founders that exited did the math, a lot of times you will see that sometimes founders didn't even get anything because they are holders of common equity and they raise so much money to fund them through their journey that their common equity at the end was nothing, unfortunately, or they paid so much taxes on it, then it's didn't leave them much. So common equity is the highest risk, aka highest return, but it's something that none of your investors that you're bringing from outside will take. They will most of the time ask for pref equity. So this is like next in line. Pref equity, they have typically some do not have voting rights. It depends on the class share, depends what's on you negotiating. They usually receive some dividends if you're a more mature company and you have extra cash to distribute, but they will be before you get in any return from exit potentially. And then that's kind of two big buckets, what we call equity investments. And again, you will hold common. Most of the equity investors will take pref. And then we'll talk about debt. I am a credit investor, debt investor, love the instrument. We all use credit cards in our real life. So I think if you're using debt smart, in a smart way for your business, it can help you a lot. Mezzanine debt is something type of financing that sits between senior debt and equity. So they are not taking kind of your whole business as a collateral, then they're just providing you money and they're saying that it's a loan that you need to repay in full plus whatever the returns, so interest rate. And I will be, if something happening in the liquidation scenarios, I will get my money back before any equity investors. And that's what mezzanine debt is. We can have the whole hour and a half about mezz debt. I will not bore you on that, but it's just something to be aware. It's like unsecured convertible notes. It's part of mezzanine debt. Any type of like second lien or kind of anything that doesn't have the word senior in it will be considered a mezzanine debt. And now senior debt. Senior debt, everyone loves it. It's what banks give you. Basically, they can write you a check for 5 million, but you need to pledge all assets of your firm. Even if your firm is valued much higher than 5 million, they will take the whole asset sleeve as a collateral. And senior lenders, if something happening or there is acquisition and exit, they are first to get their money plus interest, and then everyone else gets the residual value. So being senior debt is very secured, but we get the least return because we are taking the least amount of risk. And that's important to understand how, kind of on that pyramid as well. So that's capital stack. So that's the word we're using. Usually when I'm looking at the company and I need to understand who invested in the company and what type of shares they holding, or if there is a debt, I go into two places. I'm looking at capitalization table for equity and some debt, I can see it there. And of course, on the balance sheet, that's where I will see where the debt sits. And we will talk about balance sheet a little later. Probably Dasha covered it, so I will not spend much time of it. But you know, it's very confusing when you're trying to find type of investor that is the correct point for you to talk to at certain time. And all this pre-seed, seed, Series A, it's like so many names. So this table kind of summarizes at what stage you kind of raising what type of money. So when you have an idea, and you're obviously not generating revenue yet, you're still trying to figure out what we call product development, you don't have MVP yet, you're working on it, that's usually what we call pre-seed. And that's where accelerators, incubators, angels, family, friends, and fools are investing, or some crowdfunding platforms. That's a great place for that. Once you have MVP, and now you need to understand how am I selling it? Who am I selling it to? At what price am I doing? That's where you usually would call seed investment, where you haven't 100% figured out how you will sell your product or service. You're trying to find that market fit. You're doing some maybe pilot projects, meaning if you're B2B type of business, you maybe have a contract when you're performing a service or giving a product for free to some potential customer, and they're just like testing it. That's what we call pilot. And that's where usually the seed, and you still haven't generated any revenues from that, but you're further along from the idea. You have a product, physical product, and you're testing it out in the market. Again, very similar type of investors who will look at this. Usually it's a bigger checks, so family and friends, unless you have really nice family and friends, usually that's a little out of their league to write this type of checks. And then Series A, the holy grail of people trying to actually make it, you start generate revenue. And this is your first true institutional round. And by institutional, I mean you bring that venture firm to back you, or there's like strategic investor coming in. So Series A is usually a first institutional money coming in. And it means you prove your tech, it's working, you're generating revenue, it's pretty good vision on where you're heading, and you just need to scale and execute. So that's where your venture people coming in, venture debt is coming in. You can apply for grants. I'm climate investor, so it's a big piece of what our companies are getting. And strategics. Strategics are people who potentially can buy you as a whole company or invest in you because you're developing a technology that make that corporate work better. Like for example, in climate, a lot of construction, big, large construction developer firms that are publicly listed, they invest in smaller companies that create a new technology around how we build different or how we create a new material. Because for them to write like $1 million check, it's nothing. It's much cheaper than develop it in-house. So that's when strategics can come in and like support that little business to create something that they can then use for their benefit. And then Series B, C, it's early growth. It's where you getting up and running, getting into new market, you're expanding, you have a clear path to profitability, meaning you stop burning cash finally, and you're start to generate cash flows. And that's where bigger players like myself coming in and writing you 20 to $100 million checks to get there and really take a big chunk of the market. And then growth stage is usually for mature companies, 20, 30 million in EBITDA and plus. And that's where majority of like private equity people play, they're taking majority stake in your company. So between Series B and growth stage, this is where your exit is potentially. If you're selling your company to private equity or doing some kind of a merger, don't think that you're done with the company. You're maybe cashing out, but they probably will want for you to stay around for a couple of years as a transition period. So yeah, that's kind of a journey. Some people go through this journey within 3 years. Some people go through this journey in 30 years. It really depends on the sector, what type of business you're running, and how you thought through that capital stack. And I think that's very important to understand when you're planning your fundraise and when you're negotiating at each stage, how much equity or piece of your company are you giving out? Because people want you to be engaged and incentivized through all these 5 stages, which means you should be having pretty good incentives to stay with company. So if you at Series A own less than 50% of your company, majority of people will be like, I don't think there is enough incentive for the founder to stick around. So be very careful, especially at these earlier stages, how much equity you're giving out. Yeah. So we will chat a little bit about valuation. A lot of people want to know the secret sauce, and there is no secret sauce. It's not a science. It's more like a guessing game. There are several ways how people look at valuation. Again, depends on the sector you're in. If you're a SaaS business or your hardware business or I don't know, your retail business, it's really, really depends. So there are 5 commonly known. First one is a stage-based valuation, very appropriate for seed and pre-seed. Most of the time, it's kind of do you have MVP? How much money did you put in the company and invested, and potential market impact to determine its value. It's honestly depends on the, again, type of business. They will just look at what they've done before and say like, at this stage of you're in, you invested 500K in this company of your own money. Yes, you did some progress. So probably if I look around at the similar type of companies, we usually price them at X. And again, it's a lot of guessing games, but it's kind of ties into the second approach, with this comparable company analysis, which is very commonly used when they just look at the field of similar companies and look at what valuations this company raised money, and that valuation will apply to you. They can cut it a little bit because maybe you're a little bit earlier than those companies, or they increase it because you're further along. But comparing you to other companies that raised money, that's one of the most used approach. And for you as a founder, you need to know who in your space raised money at what valuations. Pick up the phone, call those founders, go to those happy hours and chat, and gather market insight. Because this is kind of will give you power in that negotiation room. Again, the third one is precedent transaction, ties again and very closely to the comparable company analysis. Just look what's been done before, how recent, at what valuations, and how it compares to the stage of the company you are in. And then for more mature companies, when we're talking about like Series B and exits, we're using discounted cash flow, meaning we're just taking the financial model that you build with all your projections, and we're discounting it to today's worth of money, basically. So if you're telling me that you will make 50 million of EBITDA in 5 years, there is like a very simple formula to say like how much that 50 million in 5 years worth today. And that's what discounted cash flow is. Just bunch of calculations and assumptions. And then market multiples, you see a lot of use for public companies. You can, again, take that market insight from publicly traded companies, apply a discount because you're private, and you need to apply a discount to that just because you're not as liquid. It's not as easy to sell piece of your company if you're a private company. So that's why we just use public comps on those multiples and apply a discount. But I would not worry about this bottom two. I would worry more at this stage about this top 3. And as you can see, very similar if you ever bought a house or sold a house, how you value that house you're bidding on, very similar for the valuation of your firm. Like what's in the market, what area you're in, and what the historical transactions are. Very similar approach, and it's all about data and market insight. When we talk about valuations, you probably hear a lot the terms post and pre-money valuation. Again, sounds very difficult, but actually not. The main math that is going on here, it's based on number of shares. So when you incorporate your company, you say, I have 1 million shares, and that's my pool. Like that's out of this million shares, I will give 1 to this person, 1 to this person, 1 to this person. And that's how you determine the ownership of the company. And that pool of number of shares at the beginning and as you grow, most of the time will not change, because it's very hard from a regulatory perspective to increase the pool. You will be issuing them as you go, but the number of shares that your company have most of the time will not change. And that's how you kind of determine the ownership percentage. So when we talk about pre-money, you take your valuation, whatever it is today, whatever you think it is, or whatever the investor is negotiating, and saying that my million shares worth $7 million. It means that one share of my company costs $7, right? And now we're going through Series A. Someone comes in and says, I want to invest 2 million. So now you need to understand how much shares this person is taking when they put in $2 million. And your pool is not changing. You still have 1 million shares, but you need to rebalance what you own. Your ownership percentage will go down, and you need to understand what the number is. So for that math, you need to calculate post-money valuation. And that's what you hear when people say, like, what is the post-money ownership of the company? It means if I'm putting money today, how much of the company I will end up having after this round of financing. And so your valuation was 7 million. Someone put 2 million. Your new equity value of your company is 9, right? Very, very easy. 7 plus 2 equals 9. So you have existing investors. You need to split that pool between existing investors with the same share price of $7. And that basically rebalancing. If old investors had 100%, now they diluted down and they now only have 78%. A new investor came in, they got 22% of your company for 2 billion, and the total obviously 100%. So it's all about ownership and post money, because you will be diluting yourself. So you need to understand how much of the company you will have after the investment. And again, going back to my previous point, just be careful how much you're giving up at the beginning, because at Series A, to give up 20% is okay, but don't give up 20% at the pre-seed, because then after Series A, you just start to generate revenue. If you gave up 20% at pre-seed and you need to give up 20% at Series A, then you're already down almost to 50% or 60%, depends on how it works. So very important to kind of do the math and understand. Work with your legal counsel. That's the math they are doing, and they will help you a lot to understand and project that math. So that's very common thing to work with your legal counsel, because in this example, it's super simple, but you need to use your full capitalization table and account for everyone who ever gave you money in this math, and legal counsel is the one who will do all this work for you, surprisingly. So before I jump into the next one, if you have any questions on this
Yeah,
first section, that will be great.
thank you, Lana. Before I ask any other question there is a specific question for the previous slide that you showed. Somebody wants to know, how did you arrive at 285,714? So that's a specific question. I thought since you're in that
Yeah,
slide, we should.
that's very, I'm using the table a lot, and I should stop using it because I never remember exact math. But it's basically, I believe, if you do 285, 715. Yeah, it's basically 2 million divided by like 7, because that's your share price per share, right? Yeah.
Yes. Fantastic. So there are quite a few questions for this. I will start from the top. Can you directly go from one stage to another, or need to go through each stage to move on to the next? They're referring to the pre-seed and
Yeah.
seed and series A, B.
You can call your round whatever you want. That's kind of was the reason why this second row and the third row matters. Because if it's a very easy product and service that you don't need to like develop, and it's super technical, it needs a lot of engineering, You can raise your pre-seed and then go to straight to Series A. You don't need to follow it. No, you can jump. You cannot go backwards. That's for sure. It means that something is not going right. And I will give you more complicated answer. Each of these series can have a follow-up. So you can see Series A1, Series A2, Series A3. It means whatever they were promising the investors at Series A first time, they still haven't achieved, and they still need more money, and they keep raising at the same round. And that's kind of where you know that it's probably something happening there, or there are so many people who want to invest in this company, they just like keep taking money. Yeah, so yeah, you don't need to follow it to the T. No.
Is continuously taking money without actually making a product or without actually keeping up the milestones. Is that a red flag for the company or the investors? Is that even okay to do?
Keep raising money but not getting
Yeah,
milestones.
to keep extending a specific round, Series A, for
It's a
example.
If you have a good reason for that, it's okay.
Mm-hmm.
But and as I said, maybe there are more people who want to give you more money, and you're like, yes, I will take you. Like, for example, when it was 2021 and everyone was just throwing money at people, right?
Mm-hmm.
And it was like so easy to fundraise and everyone was investing. A lot of people like took a lot of money they didn't need, and they spent a lot of money they shouldn't have spent. But last 2, 3 years been very hard to fundraise because the economy is not good. We're not getting to these milestones fast enough. Like the 21 spoiled everyone, and we just like overspent. So now it's a little more disciplined type of investing that what I'm seeing. And it's more like how fast can you get to profitability versus grow at all cost. So it's very specific per situation. If you need more money and you will raise at the same time, at the same round, if you have a good explanation that makes total sense, then it's okay. If you just like keep taking money and not getting anywhere, people will caught up, obviously, and
Mm-hmm.
it will not be a good situation
Fantastic.
for you.
Next question is for a B2C company that has launched an MVP, what should be considered small revenue?
B2C, probably between 300K to a million.
Mm-hmm.
Yeah.
The,
Depends
the
on the
next,
price of the product, right? You can sell
yes.
something for $2 and you sold it to a billion people, great. But something, if you have one unit that cost a million and you only sold one, then you have a revenue of $1 million, but you only sold one product. So it's again, it depends. With B2C, the prices are a little lower, obviously. So probably 300K to a million. Yeah.
In comparable company analysis, should we take the market leaders or should we consider competitors who are fairly new to value my company?
Whatever fits the best next to you. So whoever you will say your direct competitors are, those are the best comps.
Okay,
Maybe they are market leaders and you're really trying to disrupt the market, then yeah.
okay. But most often we don't really have a direct competitor whom we can use as the benchmark. So that makes it a little complicated, I guess.
Um, this is kind of a founder mindset, and it's great that you're unique and doing something that no one ever thought before. But there are people that doing similar things, and you have competition. Yeah, maybe their thing is a little different, and that's why they are different. But like at this specific exercise, take a step like out a little bit. Don't be super like particular and say like they're working playing in the similar space, they're trying to solve the similar problem, maybe with a different approach. They're my direct. Are they selling to the same people I will be selling? They're my direct competitors.
Mhm. Okay. So there was a comment which said that as ChatGPT, it knows all valuations and rounds of competitors, whichever is disclosed. Is this a reliable way to look at this, or is there
Why
a
not? Yeah.
preferred way?
I mean, Yeah, ChatGPT is super powerful, saves a lot of time. I will be super lying if I tell you I'm not using ChatGPT in my work. I would pay for some services like PitchBook, um, to gather information. Um, I think, yeah, as many sources of information you can get, the better. But the most reliable thing is talking to people,
Mm.
is going to your sector gathering, conferences, trade shows, and just talking to people. That will be the most reliable one. ChatGPT, PitchBook, other like what is Crunchbase, they can be a good source, but still building network is one of the best thing to do for that.
Okay. And the next question is, as far as I know, angels sometimes want to have up to 30% shares in the beginning. How do I negotiate for 20% or less than 20% at seed stage?
Um, Angels, yeah, they're fun people. Ask what they bring in besides money. Like, make them work for it, what the value add they're bringing. Because if someone is just writing you a check and then disappearing with the 30% of your company and just like waiting until you succeed, that doesn't give you anything, right? Like, I know we want cash, I know we're raising capital, but it's a long-term game, it's a marriage. You need people behind you that will help you besides just writing you a check. So in that negotiation, it's like, okay, I'm inviting you to my journey and I will make you money. But what are you helping me that I need to give you 30% today? Are you, what customers are you introducing me to? Are you helping me to build a team? Are you introducing me to other investors? Like, what value add are you bringing to me to get 30% of my company? Like, that should be a kind of a put it back on them. Like, what are you getting me? Are you following? Will be you be writing checks in the other rounds that I will be raising? Like, so yeah, ask ask all the questions like why, and how you're helping me to succeed in this
Okay.
journey.
The next question is, when you create a safe instrument or a convertible note, do you use pre or post money cap? What favors the startup?
It's a good question. You can use both, like either. It doesn't matter, to be honest. It's just like just make a math, do a math. Usually like safe should be the easiest one. It's like very like two-page form.
Mhm.
Um, Convertible notes are a little bit harder and need more legal kind of support. When I do convertible notes, I put a cap on. I do both. I do both pre and post, to be honest, because I can do pre if I know they will raise money in the future. So I want to get as much percentage when I convert. Uh, I will do post if I know that they potentially will not have another institutional round before I decide to convert. So it depends on the situation, honestly. But again, if with all these questions, if you have a very confident rationale why you're saying this or negotiate at that point, you will probably get it.
Okay. How many seed rounds before Series A? Is there a specific number? Does it even make
N-
sense?
No, like I think you should really know how much money do you need to start generate revenue. And if you're way off, then you will keep trying to raise. And pre-seed seed, it should be like one and done because you need to have a pretty clear picture how much money you need to invest before you start getting revenues in. So yeah.
Yeah, then there is a very big question, which is for seed stage-based valuation, what can you tell us about what are the stages, milestones that are being evaluated? How do they calculate the market impact?
So it's all about this table, to be honest. It's like what is your product, how much money you invested, how much are you selling, and like what's your pipeline. So it will all go back into how much money you already spent to get to this point. So it will be like a cost base, and then market value, it's like, do you have customers? Like, are there people who will buying it from you? And cost plus, I would say, meaning plus whatever the additional buzz you created. You have a pipeline, you have pilots, and you just like kind of build another tower and just like put building blocks on top of that, and that's how you create like a stage base. So it's all coming back to this kind of table, and it's super simplified, obviously, but yeah, it's like, how much money did you already spend? How much money is yours? And how much more money do you need to get to Series A or revenues or profitability later?
Then we have a very, very positive question. I'm closing seed round today, but do have several other investors who want to invest. That's an exciting prospect. Can I open another seed round in a month at higher valuation, granted several tech development and revenue milestones have been achieved?
I mean, high level, yes. If I was the one who is closing seed round, if I was an investor who is closing seed round today, I would probably be very upset if you dilute me in a month, like meaning put my ownership down because I took high risk. So again, it depends on the situation and what do you need the money, right? Like, it's great that someone wants to give you money. Amazing. You work so hard for that, but do you need this money? Like, will these people, if you go and create some extra treatment for them, they be that valuable to you? Um, do you need to piss off your existing investors, the ones that did the seed round today? So it's like so many factors to consider to answer that question. But the first one you should answer is like, do you need this money?
And also the fact that you have to go back to the same market to raise money again for subsequent rounds. And how would we impact the credibility and visibility? The
Yeah.
last question we have here is how much investors control what you do as a team during growth stage? For example, reporting to them monthly or whatever is the periodicity.
It's all negotiable again. Everything is negotiable. At the growth stage, first of all, your main reporting body is your board. So you have quarterly board meetings, and that's kind of the authority that oversees what you're doing, because the board's main responsibility is to make sure that the management team is acting in the best interest of the company and investors. So that's kind of their fiduciary duty at the board. In terms of reporting, I require monthly financial reporting. I require quarterly financial reporting. I require annual financial reporting, but it should be part of your normal operations, right? You should have close books every month and have financial statements. You're running a business, like you can't go a couple months without looking at your numbers. So it should be, when you're negotiating the reporting piece, no one will ask you, if someone is asking you to do something so extra that will be disruptive for your business, say no. If people asking for monthly financial statements, that's a normal ask. If people asking for monthly sales pipeline updates, it should be a normal ask, because you should be knowing that. You should have that type of reporting. So just balance like what your team is actually doing for you as the CEO and founder, or whatever the title you have already. But from like financial standpoint, like monthly, quarterly, and annual is super standard.
The questions keep trickling in. Can you use the pre-seed funding to pay salaries?
Yeah. You just need to just when you were talking of use of proceeds, like what are you using the money for? You just show that um, that piece will be to pay salaries, and it's okay to pay yourself, guys. Like, I know everyone is like bitching about it. Like, I think it's absolutely nonsense to expect that founders are not getting paid for years. It's like absolute nonsense.
Did you mention that with common share, people with common shares have voting or decision-making rights, like early hires and advisors who have a small amount of equity? I understand voting is only for board members, big investors, and founders.
I mean, obviously, if you own 90% of the company and other common shares like cumulatively have 10, then yeah, like whatever they decide in doesn't matter because you have 90. But if you have 10, another one has 10, third party has 10, depends on your bylaws and how your kind of corporate papers written, you may need to put them together to have a majority vote. So yeah, there are certain decisions that board deciding, but if you don't have a board, then it's like on the percentage of the company and probably majority, but it will be all written in your bylaws and corporate papers how the voting is actually done.
Fantastic. Thank you. I think that sums up all the questions for this session or this part of the talk.
Okay. Great.
We can move on to the next.
Okay. The next we're kind of diving into more like financial statements, which I think sometimes seems complicated, but there is like method to the madness, and I found it very valuable to just go through that and give people kind of understanding why income statement looks like this and what does it mean and how to use it in a decision-making process. Same with balance sheet and cash flow statement. So we will cover that. I will try to be super simple and cover a lot because we have only 45 minutes left. And I really wanted to jump into like financial modeling piece a little bit. But yeah, let's try that. I will try to cover fundamentals, just considering the time. So there are four main financial statements that we have. You probably only heard of three, but there are actually four. So there is income statement, something that you should be very, very familiar by now. Balance sheet, cash flow statement. And the fourth one, the forgotten child, is statement of change in equity. So fourth one, we will not spend time on that because it's basically your cap table, just in a different format. So that's kind of where it is. It's just tracks who is having what piece of the company. And income statement, this is where you track your revenues, your expenses over a specific period. So it can be a quarterly income, it can be annual, monthly. So you can kind of track over time and it's cumulative, right? So it's showing you the picture of your business over a period of time, which is important to understand because balance sheet is a snapshot. It's not over time. So you don't need to look at, I don't know, 3 months of balance sheet to understand what's happening. Like you do for the changes, but like balance sheet is like, what is the assets and liabilities today? And that's kind of one big difference between income statement and balance sheet. So in balance sheet is basically a list of your assets, what you own, your liabilities, how much money you owe. And the third piece is shareholders' equity, meaning how much money of retained income you accumulated over the years. Most of the time it will be negative as you're growing. And it will just show your fundraising kind of snapshot, how much money have you raised up to that specific date. Cash flow statement is the one, my favorite personally, is the one that I always look to understand what is actually cash is flowing, because income statement is not cash. Income statement has so many non-cash items that is just like accounting things. It doesn't actually show where you're making money on what and how you're spending money. So I prefer cash flow statements to kind of really dive deep into the business and analyzing this. So, but you as a founder, you need to understand all three of that. So income statement. So the main elements are obviously your revenues, how much revenue you generated. Cost of goods sold is basically what are the expenses you incurred to produce the product you sold. So meaning it's not your fixed cost. It's not your rent. It's not your, I don't know what else, like warehouse facility leasing, something that is, if you are not producing product, you still have these expenses. So in cost of goods sold is if you're producing product, what is you're spending money to produce that product. So sometimes depends on the industry, you can allocate to COGS your sales force, like how much commission you're paying, and it will be in your COGS, how much material you used, obviously. Some people figure it out how to put like energy cost in the COGS as well. It's very, very specific how you calculate the cost of goods sold per industry or type of business you're running. Gross profit is basically revenue minus cost of goods sold. It's like how much money are you making on one or units you sold, like overall profit. Then operating income will be the gross profit minus all the fixed expenses, meaning the ones that are not tied to you producing product or service. It's something you're constant, your salaries, your rent, your marketing expenses, sometimes your interest. No, interest is later. So they miss, they're not in the right order. So gross profit minus expenses, you will get your operating income. And most of the time, right now, it will be negative because you will probably have a positive gross profit, but you will have so much expenses because you need to scale that your operating income for a long time will be negative. EBITDA is something we use to just kind of get to the point, like, can you generate money before you actually pay interest on your loans? You have pay your taxes, you account for depreciation, amortization. So that's kind of a number that when we say companies break even, we mean the EBITDA break even. So there are still a lot of expenses to pay, but at least as a core business, you're profitable. So it's like you selling your product generates EBITDA positive, means that you're in a good place as a business. Then once you paid your interest on your debt, you paid your, you subtracted your depreciation amortization, you get your income before taxes, then you paid your taxes, you arrive to your net income. So it's very simple steps to take. There are different ways how they look, depends on software you're using, or you're using Excel most of the time. Doesn't actually matter as far as you're following the logic, right? It's always you have your revenues and COGS first, you arrive at your gross profit by revenues minus COGS. Then there is a section on your total operating expenses. So your general administrative expenses, selling, operating, you kind of like bucketing them in sections. So it's just easier to understand. And then everything that is not part of your main core business. So it can look like left thing, it can look like right thing. The most important piece is just to follow the logic of how you spend in the revenues, right? You spend the revenues to make the product, then you paid for all your fixed costs, then everything that just like you need to pay for the loan or anything that is not core to your business. There are a lot of different ratios kind of we can calculate using income statement that will be helpful to track over time. So you guys can make more informed decisions. And those ratios are the ones that investors will be asking. At this stage, probably the most relevant for you guys is gross margin. If you're gross margin positive, it's great, meaning you, by selling your product, you actually can make money. You're covering the cost of making that product. And some software businesses, gross margin is like 90%, 99%, right? Because there is no physical assets. They don't need to buy anything. They invested money to build this app, and now they're just selling. There is no actual costs associated with producing the product. But if you're a manufacturing business or industrial business, your gross margins might be like 10%, and it will be great. again, it depends on what industry you're in, what are your comps are you making more money than the other guy? And that's where it's most important. Again, it's comparability to other people in your space. And then other three, it's more of just like profitability metrics. Once you get there, is how much profit you are getting per unit of revenue. And the higher the percentage is, the better. And it's mostly used for like mature companies. And then compound annual growth. Everyone loves to know how fast you're growing. So that's just like a very simple formula that we use to get there. But there are a couple things that most founders don't know, especially if you don't have like financial background. As I said, income statement is a great place to analyze your business and look and make decisions. But you need to keep in mind that there are non-cash expenses that are part of the income statement. For example, like depreciation, amortization, right? If you bought a piece of equipment today, you know that tomorrow it will not cost the same if you're trying to resell it. It depreciated in value. So it's not a cash expense to you, but it's a non-cash expense to the business, because if you want to go back and sell it, you will not get the same amount of money for that, but it doesn't involve actual cash outflow. So that's important to know what is cash expense, what is non-cash expense. Or maybe there was an expense and you haven't paid it yet. So it sits in your accounts payables and you will pay it in 60 days will be actual cash outflow, but you're putting it in today's income statement because the product was sold that you use that kind of service for. One-time items, they usually sit kind of on the bottom, as I said. They're non-recurring, meaning it's like one time and done. Hopefully you will never incur that, but maybe someone will sue you. And you know that you need like spend, I don't know, 500K, but it's not a recurrent expense for you. It's like something one time off. So that will sit in that bottom section of the income statement. So you don't need to use that to evaluate your business because it's something that is like one-off situation. Then yeah, operating and non-operating expenses is how much money are you spending on actually running your business, and how much money are you spending on something like non-core, again, one-off thing, maybe some extra legal expenses, or you decided to do a team building exercise and like take everyone for a retreat, and you know you will not do it on a regular basis. So that's kind of like non-operating expenses, like something that doesn't actually represent how you're running your business, but you just made a decision to do that. And segment reporting, it's important if you have various products you're selling. So you have maybe B2C business model and you're selling to the corporates as well, B2B. When you're growing bigger, it will make sense to separate them and report them in separate lines, because people will need to know and will ask questions like, okay, your B2C business, is it profitable on its own? Is it profitable on its own, this B2B business you're running? Or you have a hardware play and you have a software play. You need to separate them to say that both of these businesses are good on their own, or maybe not, but people will be asking as you grow more and more. Yeah, time of revenue recognition. That's my favorite one, because you can get, let's say you're selling, I don't know, phones, very easy example. Someone gave you, but you need to manufacture the phones, right? So someone gave you a purchase order for 1,000,000 phones. You cannot recognize revenue if they paid you the whole thing up front, because you haven't earned that revenue yet. You may receive cash 1,000,000 today, but you haven't shipped the product to them. You haven't manufactured it yet. So it will be important. You will be recognizing revenue as you go and manufacture and ship that product, even if you received cash up front. And that's very important from like accounting perspective, because you cannot show that you made $1 million that specific month because you haven't earned that revenue yet. And that's one where early stage founders really trick sometimes. And other thing, if you're using grants is not revenue. Like, don't put that you made $2.5 million because you received a grant. Grant is not a revenue, it's a grant. It's a very different thing. It's like cash in, but it's not part of the income statement. Kind of similar thought around accrual versus cash base. Maybe you have an order and you manufactured and shipped it, but you haven't received cash yet, but you already earned the revenue. So it's kind of a reverse thing. You can recognize the revenue even if you didn't receive cash yet because how your contract is structured. And once you decide on how you treat your business and how you recognize revenues together with your accountant, try to stick to that. Don't change it every month, even every year. It's very hard to then follow the journey of your business for anyone who is looking at from outside. So do the right thing at the beginning and don't switch it unless you have a really good reason for it. But yeah, stick to one accounting policies you're already doing and try not to change it too frequently. So on the balance sheet piece, again, it's just a snapshot at the time. What assets do you have? How much money you owe? And how much money been invested in your business? So we have 3 sections of balance sheet: is assets, liability, and shareholder equity. One main equation of balance sheet is assets equal liability plus equity. The answer is yes, always. If it doesn't balance, there is a wrong number somewhere, you accounted for something wrong. Keep checking until you got it right. So when you look at the assets, they're listed in order of liquidity. You always see cash comes first because cash is liquid, the most liquid thing. Then you can have accounts receivables, right? That means that someone is sending you cash soon. Then you have fixed assets, meaning if you own a building or equipment, it's very hard to turn it into cash. It's not very liquid asset, and that's how the assets are listed. Liabilities are classified by due date. So the top one will be the ones that coming up the first. So it's something like your accounts payable. You need to pay your contractor in 15 days. That will be sitting in accounts payable, and it will be first in that liability section. If you have a long-term debt with the bank that you need to repay in 5 years, it will be sitting on the bottom of that section. And conservation principle is basically like be conservative in when you assign value to something, specifically assets. Like if you have a building you own, don't like mark it up every year if your prices in that neighborhood coming up. Keep it at like cost. Just to be conservative and not kind of using your balance sheet as your like investment brokerage account. It's really account for from very conservative space. So yeah, as I said, it usually looks like this. Again, depends using whatever software, Excel, but just make sure it's kind of buckled in the right places. So your assets, your current assets is your most liquid ones. So your cash, your accounts receivables, your inventory, your investments. Then you have your fixed assets, property and equipment, and everything other, maybe like you have some goodwill that you accumulated or you did valuation of your intellectual property. You will not see this piece much with the earlier stage companies. It's more for mature companies. And then you have your liabilities and shareholder equity. So shareholder equity piece, it's basically the section that's balancing assets and liabilities because someone paid for imbalance, right? And that will be your equity holders. So that's why your assets should equal liabilities plus equity. And that's where you kind of tracking how much common equity invested, additional paid in capital, it's how much of return they already accumulated since they invested. Retained earnings, it's your cumulative net income from your balance sheet over the years. Most of the time, this will be negative. And treasury stock is basically how much else you have reserved for shares to be issued in the future. So I will skip that just in time. For the ratios, there are several things to just consider when you're looking and analyzing balance sheet and using it for making decisions. Current ratio, basically current assets over current liabilities. Usually you're in a good spot if it's 1 or above, meaning you have enough liquid assets to pay your current bills. And it should be a good rule of thumb for everyone in our personal life and business life. Quick ratio, it's like your super liquid assets can pay for your current liabilities. So inventory takes time to sell, right? So do you have enough cash and is enough accounts receivables that are coming in very shortly to pay for all the bills that are coming in the next 30 to 60 days? Debt ratio is something just to keep an eye on, not as much at this stage. It's just like with your personal credit cards, like do you owe more money than you actually have assets, and you should not have this more than one. So yeah, keep an eye on how much liabilities you have. And working capital, you will think about this piece a lot. It's basically your current assets minus your current liabilities. If your assets are greater and working capital is positive, great. You're running your business super efficient. You don't need additional money to kind of keep up with your bills. But if it's negative, it means you need to find extra source of financing because you need to buy enough inventory to sell enough products to pay for your liabilities. So working capital is something you will be thinking a lot for, and very important piece to understand when you run a new business. Okay, I don't want to spend that much time on this, but there are several formulas. Use ChatGPT to talk about them, but I would just want to talk about cash conversion cycle. So this one is super important because it tells you how many days do you need between selling the product and receiving cash. So for example, you sold something, right? You get a purchase order for it. It took, but you need to buy inventory, produce the product, ship it, and then in the contract, whoever is buying it, they have 30 days to pay you. So you need to account for all these days in between to understand between selling point and actually receiving cash, how many days. And that will be one of the most important planning pieces of your budget, how you're running your business, and how you're negotiating with your vendors, because on the days payables outstanding, when we receive that utility bill, we have 30 days to pay. Do we pay on day one? If we're super responsible, yes. But we usually try to stretch it and pay on day 30 before we start to accumulate like late fee payment or whatever. So you will do the same with your business. If there's someone material supplier and they give you 30-day credit, they deliver the product and you have 30 days to pay, that's great, that's positive. That's why in the cash conversion cycle, you kind of subtract in that piece. So super important for you guys to dive into that. Use ChatGPT is a very common fundamental piece, but I would just like keep your eye on this, especially when you're planning how much inventory you need to buy, how many days you need to actually see the cash in your balance. Okay, I will not go into that. Just considering time. I wanted to talk about financial modeling a little bit because so we understand how the financial statements work, but then you come to these investors, they want to hear what is like opportunity, right? How big is the market that you can sell to? And that's where the things like TAM, SAM, and SOM coming up. And sometimes you need to be conservative, sometimes you need to BS it a little bit, depends on the audience. But it's important for you to have statistics and resources, like sources where you got the numbers from when you defend the market size of the opportunity you're trying to build. So TAM stands for total addressable market. So it's like total global market who even slight chance they will buy it, right? So if we are talking about selling, I don't know, lipstick, right? Your TAM will be every woman in the world. Then you go in a little bit down, what is your serviceable available market? This is the portion of the TAM that your business can actually target. Let's say your lipstick is organic, and then like, okay, out of all these women in the world, how many of them care about this product to be clean, non-chemical, whatever organic? That will be your SAM. And then your SOM is even smaller number, which is the portion of the that you can realistically capture. Like, okay, my SOM is I want to sell organic lipstick, but the color will match only like Black female. Then your actual SOM is so much smaller because how many Black female who cares about clean products are out there. And that's kind of how you build that funnel. SOM is interesting when it's billion and above for venture capital because it just shows that there is enough kind of potential to grow and make money. But don't say that's a $300 billion opportunity to sell organic lipstick to Black female because it's probably not defendable. So use the statistics, use the numbers, again, research the space. And the more you know about the market you're about like want to sell to, the more credibility you will get with investors. And it's all about numbers and data. So if you don't have numbers and data, people will just not trust what you're saying. So yeah, be clear and concise, show realistic projections, and highlight growth potentials. Like my SOM is $1 billion, but I'm starting here. I'm generating 300K right now, and this is how I will get to capture that $1 billion in sales. Then there are a lot of other key metrics that you hear a lot. So runway, it's amount of time you have until you actually run out of cash that you have on your balance sheet. So that's why it's very important to plan the milestones accordingly and fundraising rounds accordingly and how much money you spend. Because if you have 6 months runway and you're going out, you have leverage to negotiate, right? You have leverage to kind of pick your good investors, pick people you really want to work with. The closer you get into like 1 month's runway that you're running out of cash in a month, like you're not getting good terms if you're getting any because you're months away to shutting down your business. So that number you should know it every day. You should know and plan for it, and it's very important. So and it goes hand to hand to burn rate. We usually refer to a monthly burn rate, and it's how much money are you basically losing every month to run your business. And you will have a burn rate until you get to profitability, and it's okay. It's nowadays everyone trying to minimize it, like how much can you squeeze minimum amount of employees, pay the minimum salary to get to profitability, which is horrible, but like burn rate right now is something people will ask you, and you need to know right off the gate what's your burn rate, how are you decreasing it, is it possible to decrease it? If it's not, like then it's not, but you should know the numbers behind it. Then customer acquisition cost. This usually kind of around B2C or direct to consumer type of strategies, but honestly, it should be used much broader. It's basically how much money and time do you need to invest to acquire one customer? And if it's a corporate, like we usually refer it to like a sales cycle. If it's you need like 6 months between your introduction and you closing the contract, like this is 6 month sales cycle. Or if you're doing direct to consumer, how much marketing money do you need to put into the Instagram posts to acquire one customer? So you need to understand that. LTV is you acquire the customer, you spend that CAC, how much money this one person will generate you while they are your customer. if you spend $15 to acquire one customer and they're only making you $10, then this is not a good ratio, right? You're spending more money to get them than they're making you as a business. So you need to rethink your marketing strategy and how much money you're spending on that. Or maybe you're priced too low then and you're not making enough money out of them. Churn rate is you have an recurring revenues, maybe you have a SaaS platform, you have a subscription business. How many people per month are like dropping off? So they stop using your product. And that's where you go into this whole like cohort analysis and trying to understand. And these pieces are very important when you're doing your financial modeling, because that's the assumptions you're building into to project your income statement. Annual recurring revenue, monthly recurring revenue, usually used for SaaS businesses or subscription businesses, is basically if someone is signing up to your service and they're automatically being charged, how much of that is on a monthly basis, how much is on an annual basis. So you can say that I have 10 million in annual recurring revenue, but it doesn't mean you're making 10 million in revenue for 2024. It just means like at that specific point of time, all the people that subscribe to your service account for 10 million in recurring revenue. Average revenue per user, kind of the similar concept. You just like getting total revenues divided by how many customers you have and like how many on average each person brings you. Conversion rate is you doing some marketing campaign and you touched 100 people. How many out of this 100 people actually became a customer? So that's what you conversion rate and retention rate. They became a customer. It's kind of opposite from churn rate. How many of them are staying for longer time? And that's important for you to know as a part of your business compared to your competitors. And that's what you will be using for